Accounting Superstars, welcome back to the Accounting Superstar channel. Glad you're here. I'm Professor Don Bush, and I've been teaching accounting for 30 years and been a CPA for about 30 years, and I've got lots of great ways to explain accounting, and I can help you learn it. When We Get to Construction is the company we're going to work with today. So I'm going to scroll down a little bit here to these two charts. Here we go. These two charts summarize everything. What's going on is in the first chart, the top chart, this is the financial information according to generally accepted accounting principles. And the bottom chart is the same financial information, but according to the tax code, the IRS regulations. In the top chart, just to make things simple, the revenue is $100,000 each and every year, grand total of $400,000. The place where things are a little different is highlighted in yellow. With the generally accepted accounting principles, the expenses here include depreciation, which is done on the straight line basis. And since it's straight line, that means it's the same each and every year. So we have expenses of $60,000 each and every year, grand total of $240,000. Now, skipping down to the bottom line here, the income tax expense is $8,000 each and every year. So everything's the same according to the generally accepted accounting principles. But when we get down to the IRS regulations, the tax code, things are a little bit different. We start out with revenue. That's the same as above, $100,000 each and every year. Grand total $400,000. But here's where things get different. For the tax form, when we get to construction, is using MACRS depreciation. Modified Accelerated Cost Recovery System. And what this does is it gives larger deductions in the beginning years and smaller tax deductions in the later years. But it all adds up to $240,000. So $240,000 straight line, $240,000 MACRS depreciation. It all adds up to the same. So you might say, well, if it all adds up to the same, what's the big deal? Well, the big deal is with accelerated depreciation, you get larger deductions at the beginning, which means you pay less taxes at the beginning. For instance, the income tax payable is $2,000 here for the first year, $6,000 in the second year, which is less than the income tax expense according to the generally accepted accounting principles. And in the third and fourth year, the IRS catches up. That's the thing, is that they give you a bigger deduction at the beginning, but the IRS catches up and they get their money in the end. And to show that, the total amount of income tax expense is $32,000. And the total amount of income tax payable is $32,000. So it's just simply these temporary timing differences. In fact, this example of depreciation and MACRS depreciation, this was called a timing difference, a temporary timing difference. It all ends up being the same in the end. Coming down to the next chart is simply a summary of the top two charts. So we have income tax expense. All I did was take the income tax expense up here according to Gaap, and I dropped it down right here, $8,000. And I did that for each and every year, $8,000, $8,000, $8,000, $8,000, and so on. The income tax payable, all I did was take that off of the IRS regulations, the tax code chart. What's payable is $2,000, $2,000, $6,000, $6,000, and so on and so forth. And then finally, in the bottom line, I've got the difference. Tax expense is $8,000. What they have to pay to the government is $2,000. So there's a temporary timing difference of $6,000. And since the IRS will be catching up in the end, we call this a deferred tax liability. Same thing's happening in 2002. Income tax expense was $8,000. Income tax payable, $6,000. The difference is $2,000. And the $2,000 represents the amount of money that the IRS is going to catch up in the end here. So $6,000 and $2,000, that's a grand total of $8,000. And you can see already in the later years, this is going to be reversed back out. So in the year 2003, the income tax expense is $8,000, but what is payable to the government, what they have to pay out in cash to the government is $10,000. So the difference is $2,000, but we're writing it as a -2 because the deferred tax liability is getting reversed out. The government is in fact beginning to catch up. So in 2004, same sort of deal, income tax expense, $8,000, income tax payable, that's what they owe the government, $14,000, and the difference is $6,000. And what happens is in the end, the government completely catches up. So to put it all another way, the deferred tax liability, the amount of money that the government is going to catch up, starts out being $6,000, and then another 2 is added to it. But then the government begins to catch up, so 2 is minused away, and the government catches up again for another -6,000. So it all ends up that the government does in fact catch up. So coming down here to the journal entries, income tax expense, $8,000. I got it right here off the chart. Income tax expense, this is according to generally accepted accounting principles. Income tax payable is $2,000. This is the amount that's got to be paid to the government. And so we have $2,000. The difference is $6,000, and the difference is going to go right here as a credit to make our journal entry balance. So $8,000 equals $6,000 plus $2,000. There we go. Coming down to the partial generally accepted accounting principle balance sheet. So these are the company's financial statements. So we have here in the long-term liabilities, not the current liabilities, but the long-term liabilities, we have a current tax liability of $6,000. Where'd that come from? Well, it came from the journal entry, and it also came from the chart, $6,000. Coming over here to the income statement. Coming here to the income statement, we are focusing on income tax expense. The current amount due for income taxes is $2,000. We get that from the income tax payable. What is deferred is the $6,000. That is the amount that the government's going to catch up. That's the deferred tax liability, $6,000. Now $2,000 plus $6,000 is $8,000, and we have $8,000 here, which matches the generally accepted accounting principles income tax expense. Coming down to the second year, I have it in blue so it matches. So the journal entry, income tax expense is $8,000. Get it right off the chart there. The income tax payable to the government this year is $6,000. Income tax payable according to the tax code. The deferred liability is $2,000, and we get that right here off the chart also. $8,000 equals $2,000 plus $6,000, so it all balances. The deferred tax liability on the balance sheet for year 2, it's a long-term liability, not a current liability. Deferred tax liability is $8,000, and you might wonder, why is it $8,000? Well, $6,000 plus $2,000 is $8,000. Over to the income statement. We're interested in the income tax expense section. The current amount that we have to pay the government is $6,000. So income tax payable, $6,000, $6,000. What is deferred this period? Well, $2,000 is deferred this period. So deferred, 6 plus 2 is $8,000, which matches the income tax expense according to Gaap. Coming down to the third year, a salmon pink color. Income tax expense is $8,000. We get that right off the chart. Income tax payable, that's the amount due to the IRS this year, $10,000 right off the chart. Now to make it balance, we need to debit deferred tax liability. So this debit is reversing out the tax liability. Coming down to the balance sheet, long-term liabilities, not current liabilities. Deferred tax liability is $6,000. Why $6,000? Well, $6,000 plus $2,000 minus $2,000 is $6,000. Coming over here to the Gaap income statement, the current taxes due this period is $10,000. And the deferred is getting reversed out because it's a debit there. It's being reversed out. And we end up with the Gaap amount of income tax expense, $8,000. 2004 here in a gray color. Income tax expense, $8,000, got it right off the chart. Income tax payable, $14,000, right off the chart. That's the amount that's due this year. And deferred tax liability has got to be a debit in order to make this journal entry balance. It means that the government is catching up. It means that we're reversing out that tax liability. Coming down to the partial balance sheet, we have zero. And you might be saying, why is it zero? Well, 6,000 plus 2,000 minus 2,000 minus another 6 is 0. So the deferred tax liability has now been completely reversed. The government has completely caught up. So to the income statement, current 14,000, that's the amount of income tax payable here. For the current year, deferred, that's the debit of 6,000. We're reversing out the 6,000. And we end up with 8. 14 minus 6 is 8,000. So ladies and gentlemen, so what did we learn today? Well, probably most importantly is when companies do their books, they do their books one way, according to generally accepted accounting principles, and they do their taxes according to IRS regulations, which is a totally different way. And the two ways are not the same. And so there are some discrepancies here, and we need to make our books balance and make it all work out. So that's why we have this chapter in intermediate accounting on deferred tax liabilities. So I hope you enjoyed this lesson. And if you did, hit the like button and subscribe, and I'll make some more of these videos for you. Until then, over and out.